In this video, we'll be continuing with market structure. Breakoff structure will be our topic of focus for the episode 2 of market structure. Make sure you watch till the end and follow the series of market structure videos to understand it better. Welcome back to my YouTube channel. This is BOFX, USDCHF legend aka God and Chart. Firstly, we will start with what is Breakoff structure. Breakoff structure is a significant price movement where the market price breaks through key level of support or resistance. This indicates potential shift in market trend. They can signal change in market trend and a potential for a new market to develop. Breakoff structure can be classified into two. One, the bullish Breakoff structure, and two, the bearish Breakoff structure. Now, what do we mean by the bullish Breakoff structure? A bullish Breakoff structure occurs when a market price breaks through a key level of resistance in an upward direction. This breach of resistance level suggests that buyers have gained control and they are pushing the price higher. That is a break of the lower high. It can indicate a potential shift from a previous downtrend to a new uptrend. Traders often consider a bullish Breakoff structures as a buy signal, suggesting that the market can continue to rise in the near future. Identifying a bullish Breakoff structure in forex trading involves 1. Analyzing price chart, looking for specific signs and patterns. To identify a bullish Breakoff structure, you must endeavor to identify the previous trend to know when the new trend is starting. 2. Bearish Breakoff structure. A bearish Breakoff structure occurs when the market price breaks through a key level of support in a downward direction. That is the break of the previous higher low. This breach of support suggests that the sellers are now in control or the sellers have gained power and they are pushing the price lower. This suggests a potential shift from a previous uptrend to a new downtrend. Traders often consider a bearish Breakoff structure as a sell signal, suggesting that the market can continue to decline in the near future. Identifying a bearish Breakoff structure involves 1. Analyzing the price chart, 2. Looking for specific signs and patterns. It is important to wait for confirmation candles to ensure that the market has changed direction to a bearish market. Now let's continue from where we stopped from the last episode. Now today we will be going more deeper than what we did the last time. So just a quick recap of what we did the last time. So this is what we did the last time. If you remember, the higher high and the higher low. If you remember, now this is what is inside the book. This is what the book will teach you as a trader. This is what you are expected to be seeing inside the book. But in the live market, it is not always like this. The book will teach you a normal or a simple higher high and higher low in this format. But today we'll be going more deeper to a more complex one, but I'll make it very simple as possible. And then from there we'll be talking about our primary focus for today, which is the Breakoff structure. After we talk about the simple and the complex one. So it's not so complex, it's just that you need to understand it. If you don't understand the primary, to understand the advanced one will be a little bit difficult. So just follow me the way I'll be doing it now to understand it better. So remember, this is higher high, then the higher low. This is what the book will teach. This is what the book will explain to everybody. But in the live market, it is always different. Then you will see what I'm talking about by the time I'm done with this. And this simple one are the one we see in the book, that we read in the book, that we study in the book. What we see in the live market is different. Now let's draw the one that actually happened in the live market. This is how it is in the live market. It's not always smooth in the live market. It is always very confusing. Very confusing. This is how it will be in the live market. Let's stop here.
Again, for the bearish market, that is for the bullish market. For the bearish, let's continue. This high, it is always like in the live market, so it's not always as easy or as smooth as it is the way it is inside the book. So that is why you have to understand it deeply and fully. So if you don't understand it, you will get it very wrong. Now let's label it like this. So this is what is inside the book. This is the simple one. This is the primary one. This is the primary one here. So this is what this is in the live market. This is why many people get it wrong. When people lose in the forex market, because they didn't understand it. So if you don't understand the primary one, there's no how you'll be able to interpret the live one, what's inside them, what happened actually in the market. So we are going to be doing it together, so you get it straight, you'll be able to understand it better than what you've known before. So as you can see, now let's label it. Remember what I told you, all what we need for a bullish trend is just three things. We need the high, the high that's higher than the previous high. We need the higher low, the low that is higher than the previous low, and then the third one, we need the what? The ordinary high for the bullish market. Now, and for the bearish market here, for the bearish market, we need what? We need the lower low, we need the lower high, and the last one is we need the ordinary low. I will introduce another low to this place, because we are getting to a complex one now. So we have 4 things now, and I will introduce I here too as well. Now let's begin. So these are the 4 things we need for the complex ones. So these are the 4 things we need for the complex ones, and these are the 4 things we need as well for the bullish, and these are the 4 things we need for the bearish. Now remember what I told you in my last video. Higher high, it is high that is higher than the previous high. Higher low, it is a what? It is a low that is higher than the previous low. We have the ordinary high and we have the ordinary low as well. And again, for the bearish market, we have lower low. This is the low that is lower than the previous low. The lower high, it is what? Lower high, it is a high that is lower than the previous high. And then we have the ordinary high and we have the ordinary low. Now let's label this one. Let's see how it will look like. Let's use these four items to label this one, and for the bearish and for the bullish. This is for the bullish going upward, this is for the bearish going downward. Now remember, we started from this place. So we started from this place. This should be ordinary low. So that's how we come about it. So this one going to be high. So remember, if you look at this one very well, you will see that they are of equal place. They are of equal place. So let's just mark it like that. They are equal something. So since so far they are of equal something, it is still at the same place. So you can call it an higher high at the moment. All we will just call it is still ordinary high, because that place is not higher than the first place. So we have 2 high at that place. So we have 2 high at that place. Okay. Now this place, so you see that they are equal too. So this is a higher low. We have higher low here. Remember. So far they are equal here. This one will be ordinary low, because they are still at equal place. Now this is the first breakout we have, giving us what? Higher high. This place is an high because this place is higher than these 2 places. So we have what? We have higher high at this place. Then here is the higher low. Remember, we join it together like this. And you see how we are able to figure everything out now. But what I want you to see in this side is that you can see that this is the higher low, and the market come back to this place again the second time. Market come back to this place again the third time. So since that the market is still at the same region, this is the higher low here, and then this is an higher high. So this is another higher high here. Normally, what we are supposed to be having after an higher high is supposed to be an higher low, which is supposed to be reaching this place, but that is inside the book. But in the live market, it is not always perfect that way. So market came back to this low at this place again. So coming back to this place will not be called higher low again. It will now be ordinary low, because it is now lower than the normal higher low. So it's not at the same level as the previous higher low. So this place will be called an ordinary low. So it will not be higher low again. This second place will be called an ordinary low. Any other market coming to that region is low, low, low. Since market is still respecting that level, it will always be low until the market break it. So that is how we will be coming about Breakoff structure. But we are still here to get there. Let's continue like this. So this one will be ordinary low, ordinary low. This one is higher low. Market go up, forming an higher high. Market came back to the previous higher low. So instead of saying higher low the second time, we won't be saying higher low again. So that place now become ordinary low. Then market go up again. So going up again, you will see that market didn't this market doesn't go above this place again. So we can't call this one another higher high. So this one is just ordinary high at this place. The market came back again downward. Then we have another low again. From there, market push up again above this high here again. Then we have another higher high at this region. Market came back again at the midway. Then this is an higher low. So the moment market come back to that region the second time, it will not be higher low any longer. The second time, it will not be ordinary low. If market come back to that place the third time, it will still be ordinary low. The fourth time, it will still be ordinary low until market break it out. But if the market is still respecting that place, or any other market coming to that region will be ordinary low. Then again, we have another higher high. Let's see for the bearish market. Now for this bearish market now, this is how market looks like in the live account. In the market, actually, this is how it is. You can see that it's not easy to figure out if you don't understand this, the basis of all these structures. So this is how textbook will explain for you, or this is how the books will explain to you, the higher high, higher low, like that. But this is what the market will be showing you. That's why many people don't get it, and that's why many people get it wrong in the market. Now let's label this one too. Let's see how it looks like. After low, coming up here is a lower high. Market is still maintaining that same level. So let me draw it out. I'm going to repeat it again. Once again, that place is still low because market has not broken that region. The market broke this place. We have what? We have another what? Another lower low. And again, remember what I told you. Market, instead of market to stop at the midpoint here. Okay, look at what happened here. Market stop at the midpoint here. That's how market supposed to stop at the midpoint. That's how we have a lower high at this place. Instead of market should stop at midpoint, market didn't stop there. Instead of market should stop somewhere around here, market didn't stop. So market go back to the previous high at this place. So since such happened, then that place will become an ordinary high again. Remember, in the bullish trend, we say ordinary low, ordinary low. Here it will now be ordinary high in the bearish trend. So for the bearish trend, this place will now become ordinary high here. Here's another lower low again. Then look at what happened here. Market didn't break this place. Then we have an equal low. Then here is lower high at this place. Then the last lower low here. So can you see the difference between the book explanation of market structure and what happened actually on live market? So this is why many people fail in the live market. What you read about in books is quite far from what actually happened in the live market. So that is the difference between the book and the live market. So the book will always tell you that the higher low, the higher high, the higher low, the higher high, very smooth like that. But when you come to market, actually it's not always like that. So it's always different. So market is not always moving as smooth as that. Market is always confusing. But the moment you understand all these things, everything becomes so easy for you. So how do market change from bullish to bearish, and how do market change from bearish to bullish? Market is not unable to form another higher high or a new higher high. The market come down straight down like that. So this is the last higher low. The moment market break this last higher low, that is where the market finally break structure. Let me just label this. Remember what I told you in my previous explanation. The moment market came back to that place again the second time, this will not be, and market is unable to break it up, then this will be ordinary high. But this is an ordinary high here. This is the last higher low. So the moment market break through the last higher low, that is where there is a break of structure. This is the last higher, so this is the BOS point. So ideally, if this market stop at this place, we are going to call it what? We are going to call it ordinary low. If the market has stopped at this place and go up again to form another higher high, and the moment market didn't stop at this place for ordinary low, the moment market break through this place, then it will now become what? The market broke the last higher low down here. This is a lower low. Then from there, we have the change of direction. Then from bullish, market change direction to bearish, maybe a lower high. So this is our market change from bullish to bearish. So this is bullish trend. Market will change from bullish to bearish when the market break the last significant higher low. So market change from bullish to bearish when market break the last significant higher low. So this change from the bullish trend to bearish trend. Now let's now look from the bearish trend to bullish trend. Now let's cancel this and let's see from bearish trend to bullish trend. Let's see how it looks like. Let me start the labeling from here. Then here is lower high. This is another lower low here. Then the moment market is unable to break that last lower low, then that means market is what? Market is about to change direction. Market form an equal place here, and that place will be called what? That place is an ordinary low, as we have it in a bullish trend. Remember, as ordinary high, we have it as ordinary low here as well. Then from there, this is the BOS point. So the moment market break through the last significant lower high, that is the BOS, which is the break of what? The break of structure. This is the BOS. So from there, this is the first significant higher high here. Then market change from bearish to bullish. So this here is an higher high. So to bullish trend. Then what is the condition for the change? So market change from bearish to bullish when market break the last significant lower high, which happens here. So this is break of structure for bearish to bullish. So for my next episode, we'll move into chart analysis. Then from there, you'll be learning better and better.
I'm sure you've been able to learn break of structure in this episode of market structure. If you are watching for the first time, ensure to watch the first episode to understand it from the beginning. Comment below on your understanding of market structure so far in your trading journey. Ensure to like and subscribe to this channel. That is the only way we can grow together. Until next time, stay profitable.